You ever feel like the stock market is just this giant, unsolvable puzzle? Yeah, you're not alone. In this explainer, we're going to pull back the curtain and decode three expert playbooks for finding great investments. And we're going to look way beyond the usual big names that are always in the headlines.
I mean, let's be honest. It's a really confusing time to be an investor. You've got this massive hype around AI that's sending some stocks to the moon. But at the same time, you're seeing these big tech sell-offs and hearing whispers that maybe, just maybe, those super high valuations are about to come back down to earth. It makes it so tough to figure out where you should even start looking. But here's the secret. The pros don't just guess. They aren't just throwing darts at a board hoping to get lucky. They use systematic, repeatable methods, we're calling them playbooks, to cut through all that noise, sift through thousands of companies, and pinpoint the ones that have real potential. And that's exactly what we're going to break down today.
So, here's what's on deck. We're going to dive into the strong buy system, then the dividend growth shield, and finally, the value hunter's playbook. And once we've covered all three, we'll help you figure out which one of these strategies might just be the perfect fit for you. Okay, first up is the strong buy system. Now, this is a purely quantitative approach. It's all about letting the data, not gut feelings or emotions, do the talking and find stocks that might be getting ready to make a big move. At the very heart of this system is something called the Zacks rank. Now, the core idea here is actually pretty simple, but it's incredibly powerful. When the professional analysts who cover a company start upgrading their expectations for its future earnings, well, the stock price very often follows that trend. Why? Because those upward revisions are often the first hint that a business is getting stronger, sometimes way before the rest of the market catches on. So, what's actually under the hood? It really boils down to four key factors. First, agreement. Are all the analysts on the same page, raising their estimates together? Second, magnitude. Are we talking about a tiny little bump or a major significant jump in expectations? Third is upside. Is there one top-performing analyst who's seeing something that everyone else is missing? And finally, surprise. Did the company just come out and absolutely crush its last earnings report? And you know what? The track record really speaks for itself. Since 1988, stocks that earned that #1 strong buy rating have delivered an average annual return of almost 24%. 24%. That's more than double what the S&P 500 did over that same period. It just shows you how powerful a purely data-driven approach can be. And what's really cool is this system doesn't just point you to the same big tech companies you hear about every single day. For instance, it recently flagged Plains GP Holdings, which is an energy pipeline operator. Probably not a household name for most of us, but its strong earnings momentum was enough to earn it that top rating. It's a perfect example of how this playbook can uncover opportunities totally off the beaten path.
All right, let's move on to our second playbook, the dividend growth shield. Now, this one takes a completely different angle. It's not about chasing short-term momentum. It's about building a defensive portfolio that's designed for stability, especially when the market gets choppy. This strategy is called dividend growth investing. The whole focus here is on mature, well-established companies that don't just pay a dividend, but have a long, proven history of increasing that payout year after year after year. Think about it. A consistently growing dividend is one of the strongest signals you can get about a company's financial health and its management's confidence in the future. So if you're following this playbook, you've got a pretty strict checklist. You're looking for at least 5 straight years of growth across the board, in dividends, in sales, and in earnings. You want to see that analysts expect more growth in the future. You want a valuation that's reasonable. And you want a stock that's already been showing its strength. It's really a hunt for all-around, high-quality businesses. So what kind of company fits this mold? Well, a fantastic example is HCA Healthcare. As the biggest non-governmental hospital operator in the US, it's a mature business in a really stable industry. It has that great track record of consistently raising its dividend, all backed by rock-solid fundamentals. It's a classic fit for this dividend growth strategy. Okay, that brings us to our third and final playbook, the Value Hunter's Playbook. This one is all about finding those hidden gems, the diamonds in the rough. In a market where everything seems expensive, this strategy asks one simple question. What is everyone else overlooking? It's the art of the bargain hunt. And that's a really important question to be asking right now. A key metric called the Shiller PE ratio shows that the stock market is trading near its highest valuation since, get this, the dot-com bubble back in 2000. So when prices are this high across the board, finding a genuine bargain gets a lot harder, but it also becomes way more rewarding when you do. This is where the classic strategy of value investing comes into play. The core idea is simple: buy stocks for less than what they're actually worth. The old saying is buy a dollar for 50 cents. That discount creates what value investors call a margin of safety, which acts like a built-in cushion to help protect your investment if things go south. Let's make this real with an example. Take a look at Citigroup. Now, it's faced some challenges, for sure, and as a result, it trades at a pretty big discount. Its price to tangible book value is just over 1, while a competitor like JP Morgan is trading at almost 3 times its book value. A value hunter sees that huge gap and thinks, maybe there's an opportunity here that the market is just too pessimistic about. And value opportunities don't just show up in struggling companies either. Look at Progressive. It's a top-tier auto insurer with a fantastic long-term track record, but after a really tough cycle for the whole insurance industry, the stock has taken a hit over the past year. For a value investor, that's not a sign of a bad company. It's a potential window to buy a great business while it's temporarily on sale. And this is why they do it. This is the long-term payoff. An incredible 10,780% return over the last 30 years. It's just a powerful, powerful illustration of what happens when you buy a high-quality business at a fair price and then just have the patience to let it do its thing. Okay, so we've walked through 3 very different but very powerful playbooks. Now we get to the most important part. Which one is the right one for you? Let's figure out how you can choose your strategy. Let's just summarize it all here. The strong buy system, that's all about using data to find short-term momentum, which is perfect if you're a numbers-driven investor. The dividend growth shield prioritizes financial health and stability, which is ideal if you're looking to build a more defensive portfolio. And the value hunter's playbook, well, that's for the patient investor who wants to find those long-term bargains and build in a margin of safety. The biggest takeaway from all of this is that there is no magic formula. There is no single right way to find great stocks. Each one of these playbooks has its own strengths and weaknesses. The best strategy is always going to be the one that you understand, that you believe in, and that truly aligns with your personal financial goals and your own tolerance for risk. So now that you've seen how the experts do it, whether they're data crunchers, stability seekers, or bargain hunters, the final question really is for you. What kind of investor do you want to be?